that little piece of plastic in your wallet. We swipe it, tap it, and insert it without a second thought. But have you ever stopped to wonder how this simple object completely rewired our society? It's not just a payment method, it's a cultural phenomenon that turned convenience into a multi-trillion-dollar debt machine. You're watching Cultural Capital TV, where psychology, money, culture, and history meet, because nothing is ever as simple as it looks. Today, we're exposing the hidden story of the credit card. We'll trace its evolution from a simple perk for diners in the 1950s to the cornerstone of modern consumerism, revolving debt, and the buy now, pay later world we live in today. Why should you care? Even if you meticulously pay off your balance every month, the system itself has fundamentally changed. Credit transformed from a privilege to a necessity, and the very idea of affordability has been warped. This shift affects everyone. We'll cover the innovative origins of the first cards, their explosion into mass culture, the crucial pivot to revolving credit, and the modern debt traps disguised as convenience. And most importantly, we'll discuss what this all means for you and your financial future. Let's rewind to 1950. The story begins, as many do, with a forgotten wallet. A man named Frank McNamara was at a business dinner in New York City when he realized he didn't have cash to pay the bill. The embarrassing moment sparked an idea. What if there was a way to pay at multiple establishments without carrying cash? A few months later, he and his co-founders launched the Diners Club card. It was a simple cardboard rectangle, and initially it was only accepted at 27 restaurants in New York. But it was revolutionary. This wasn't a credit card as we know it today. It was a charge card. The deal was simple. You use the card throughout the month, and at the end of it, you pay the entire bill in full. There was no interest, no minimum payments, no carrying a balance. Its purpose was sheer convenience for a small, affluent group of businessmen. But the core concept, paying later for something you consumed today, with a single card that worked in multiple places, was a monumental shift. It detached the act of purchasing from the immediate pain of payment. For the first time, a portable, universal payment promise existed. This brilliant idea didn't stay small for long. Banks saw the potential and wanted in. By the late 1950s and into the 60s, institutions like Bank of America began experimenting. They launched their own card, the Bank AmeriCard, which would eventually evolve into the global behemoth we know as Visa. But they added a game-changing twist: revolving credit. Unlike the Diners Club model, you didn't have to pay the full balance. You could now carry debt from one month to the next, as long as you made a minimum payment. And for this privilege, the bank would charge you interest. This was the birth of the modern credit card system and the financial engine that would power the next 70 years of consumer culture. With the introduction of revolving credit, the floodgates opened. The 1960s and 70s saw credit cards morph from a niche convenience into a powerful symbol of the American dream. The phrase, "charge it," became a cultural mantra. It represented freedom, status, and the power of immediate gratification. Why save up for a new television when you could have it right now? The logic was seductive. Convenience was the sales pitch, but consumption was the goal. Behind the scenes, a massive infrastructure was being built. Card issuers like Visa and MasterCard weren't just selling a product. They were building networks. They convinced millions of merchants to accept their cards by promising them more sales, and they attracted millions of customers by promising them universal acceptance. This created a powerful feedback loop. The more stores that took the card, the more useful it was for customers. The more customers who had the card, the more essential it was for stores to accept it. This network effect shifted power dramatically toward the card issuers. The psychological impact was profound. The deferred nature of credit card payments fundamentally changed our relationship with money. When you pay with cash, you feel the loss immediately. But with plastic, the transaction is abstract. It's just a swipe and a signature. This psychological distance makes it much, much easier to spend. The buy now, pay later mentality went from being an exception for large purchases, like a car or a house, to the default for everyday life. Coffee, groceries, movie tickets, everything was now credit-worthy. And while this wave of convenience washed over society, the early signs of risk were already appearing. Credit limits started to creep up, and the concept of a revolving balance, once a novelty, was becoming dangerously normal. The most critical turning point in this story was the strategic shift from pay in full to pay the minimum. This wasn't just a feature, it was a business model. For the banks and card issuers, the most profitable customers weren't the responsible ones who paid their balance every month. The ideal customer was the revolver, someone who consistently carried a balance and paid interest month after month, year after year. The entire marketing machine was built to encourage this behavior. The messaging was all about freedom, rewards, and convenience. Your card is accepted everywhere. Earn points on every purchase. Get 5% cash back. These perks weren't really free. They were incentives, carefully designed psychological nudges to get you to use the card more often and, ideally, to not pay it off in full. The cost of the rewards program is more than covered by the high interest rates paid by those who carry a balance, and the data shows this strategy has been wildly successful. According to the Federal Reserve Bank of St. Louis, credit card delinquencies have been climbing steadily. This means more and more people are falling behind on their payments. At the same time, a recent report from Bankrate shows a huge number of Americans now carry credit card debt from month to month. The convenience of a simple swipe has a hidden cost, and that cost is long-term, high-interest debt. The very design of the system makes it easy to spend today and pushes the consequences far into the future, creating a culture where carrying debt is no longer a sign of emergency, but a normal part of financial life. Now, we've entered a new, supercharged era. The principles of credit have been amplified by technology. Fintech companies and digital payment platforms have pushed the boundaries even further. We now have instant credit decisions, seamless in-app payments, and the explosive rise of buy now, pay later services, or BNPL. These services, offered by companies like Klarna and Afterpay, break down a purchase into smaller, interest-free installments. It sounds great, right? Pay just $25 today for that $100 jacket. But look closely. It's the same psychological trick, just repackaged for a new generation. It further reduces the friction of spending and normalizes debt for even the smallest purchases. The promise is convenience and affordability, but the result is often stacked debts from multiple purchases, making it harder to track total spending. The data is alarming. The Federal Reserve Bank of New York reported that total U.S. household debt recently hit a record high of over $18 trillion, with credit card and consumer debt being significant drivers. It's not just a few people struggling, it's a systemic issue. Research using machine learning has shown a direct link. When banks give consumers higher credit limits, those consumers tend to spend more and fall into deeper debt. The system is designed to encourage this. The modern debt culture is now intricately woven into our identity. It's not just about buying things, it's about a lifestyle. Premium cards offer travel rewards and exclusive access, turning debt into a status symbol. We're bombarded with marketing that links credit to aspiration, the dream vacation, the designer wardrobe, the perfect life, all available now, with payments to be worried about later. This sophisticated marketing makes consumers feel like they're being savvy, chasing points and maximizing rewards, when in reality, they are often being drawn deeper into a system designed to profit from their debt. When you step back and look at the entire 70-year history, a clear pattern emerges. It starts with an offer of convenience or novelty, the first charge card, the first rewards program. Then comes the expansion of access, more merchants accepting cards, more customers getting approved. This is followed by a fundamental shift in payment behavior, from paying in full to normalized revolving debt. And finally, we see the inevitable outcome: explosive growth in consumer debt, rising delinquencies, and systemic financial risk. What has changed over the decades is the technology. We've gone from cardboard and paper slips to magnetic stripes, chips, and now contactless and digital payments. The marketing has become infinitely more sophisticated, using vast amounts of data to target us with personalized offers. But what has stayed exactly the same is the core economic principle. The business model still relies on the magic of compound interest and the psychology of deferred payment. The behavioral incentives, the desire for ease, social status, and immediate gratification are as powerful today as they were in the 1970s, and the risk of spending more than you can afford remains the central danger. So why does understanding this history matter so much? Because it empowers you. It reveals that getting caught in a debt trap isn't always a personal failing. It's often the predictable result of a system masterfully designed to encourage that very outcome. By recognizing the playbook, you can protect yourself. Be aware of the red flags in your own behavior. Are you consistently carrying a high balance relative to your limit? This is known as high credit utilization, and it's a major warning sign. Are you only ever paying the minimum amount due? That's a direct path to paying double or triple for your original purchases through interest. Are you chasing rewards so hard that you're spending more than you otherwise would? Here are some practical steps. First, try to treat your credit card like a debit card. If you don't have the cash in your bank account to cover the purchase right now, seriously reconsider making it. Second, actively monitor your credit utilization and strive to keep it low. Experts often recommend below 30%. Third, always understand the difference between your statement balance and the minimum payment. The goal should always be to pay the full statement balance. Finally, be relentlessly aware of the psychological nudges, those rewards, that feeling of status, the illusion of free money. Recognize them for what they are: marketing tools. Always ask yourself, is this purchase worth it if I had to pay for it in full, with cash, right this second? The story of the credit card is the story of modern consumption itself. It's a tale of convenience, innovation, and the subtle cultural shifts that created our debt-fueled world. Knowing this history doesn't mean you should cut up your cards and live off the grid. It means you can walk away from this video informed and empowered, not powerless. What was the first purchase you ever made on a credit card? Let us know in the comments below, and tell us if you paid it off right away or carried the balance. If you found this breakdown helpful and want to dive deeper into the hidden systems that shape our world, make sure to subscribe to Cultural Capital TV. Knowledge of the past empowers you to navigate the present. Treat credit as a tool, not a trap. Thanks for watching.